Welcome to The Explainer. Today, we're going to break down Lending Club's absolutely stellar third quarter, taking their complex earnings report and making it simple.
So, here's what we're covering. We'll start with the huge headline numbers, then dig into what's driving all that growth. After that, we'll look at their unique business model, check on their financial health, and finally, see what they're predicting for the rest of the year. All of this comes straight from their latest report.
Okay, let's just jump right in. Lending Club's third quarter was, well, pretty exceptional. And the whole story really starts with three powerful numbers that tell you everything you need to know about their momentum right now. First up, loan originations. Now, this is the absolute core of their business, how many new loans they're actually creating. And it surged by an incredible 37% compared to last year. That's not just simple growth, folks, that's some serious acceleration.
And, of course, that massive growth in new loans translates directly to revenue, which shot up 32%. This shows they're not just busy making loans, they're turning all that activity directly into cash. That's a super healthy sign for an expanding business.
And here's the kicker. All that growth flowed right down to the bottom line. Their profitability, which we measure by diluted earnings per share, nearly tripled, hitting 37 cents. This is the real so what of the story. It proves their business model is getting more and more efficient as it gets bigger.
So you might be asking, where is all this growth actually coming from? Well, it all starts with their bread and butter, loan originations. Let's peel back the onion a bit and look at the how behind these huge numbers.
So get this, the company pumped out over $2.6 billion in new loans this quarter alone. That's not just a multi-year high, it actually smashed their own forecast. I mean, they're outperforming even their own best-case scenarios.
Now, what's really cool here is that this isn't just one thing going right. It's a multifaceted strategy that's firing on all cylinders. You've got a ton of people wanting to refinance high-interest credit card debt, and at the same time, a hungry market of investors ready to buy those loans. Add in some smart marketing and a brand new product that's attracting big insurance money, and boom, you've got a recipe for success.
Okay, so let's follow the money and see how all this loan growth actually turns into revenue. This is where you really see their unique digital marketplace model shine. Think of it as having two powerful engines making money at the same time, and you got to understand both to get the full picture. On one hand, you have the marketplace. This is where they sell loans to partners, banks, asset managers, you name it, and they earn fees right away. And that part of the business is just on fire, growing a whopping 75%. Then, on the other hand, you have the bank. This is where they keep some loans for themselves, on their own books, and just collect that sweet recurring interest over time. It provides a super stable, durable income stream that just hit an all-time high.
And this chart just shows that balance perfectly, see? While the marketplace revenue gives them that explosive growth, it's the bigger, steadier income from their own balance sheet that forms the rock-solid foundation. This hybrid model really gives them the best of both worlds: high growth potential and long-term stability.
Now, you might think this kind of crazy growth could be reckless, but nope. When you look closer at their financials, you see a really stable, well-managed company that's built for the long haul. Okay, a little bit of jargon here, but stick with me. Analysts love looking at a metric called PPNR. All it really means is how much profit the core business is making before they set aside money for potential loan losses. A 58% jump here is just massive, because it proves that as their revenue is soaring, their expenses are not. And that, my friends, is what we call powerful operating leverage.
This little dashboard here is like a quick health checkup for the company. And the doctor says things are looking good. Credit quality is strong, profit margins are getting wider, and their asset base and value per share just keep on climbing. It's a picture of all-around financial strength.
You don't have to take my word for it. The CFO himself summed it up perfectly. He said the business is firing on all cylinders, and he points right to the unique strength of their hybrid bank model as the reason why. All right, so with a quarter that strong in the rearview mirror, what's next? What does the company think the rest of the year is going to look like? Let's check out their official guidance for Q4. So the big question for investors and for us is whether this amazing performance was a one-time thing or if they can keep this momentum going right through the fourth quarter, which, can sometimes be a little slower because of the holidays.
Well, Lending Club's official guidance pretty much screams, yes, we can.
They're expecting to continue this incredible year-over-year growth in both originations and core profits. And here's the really crucial part. They're projecting their ROTCE, that's a key measure of how efficiently they make profits for shareholders, to more than triple compared to last year. And that's even with the holiday season factored in. Pretty amazing.
So the big takeaway here is crystal clear. Lending Club is just nailing its strategy right now, and the results are pointing to some serious future potential. It really just leaves us with one final thought. With their business model now proven to be firing on all cylinders, how high can this thing actually fly?